Did you know that there's actually two different types of inflation? Now, this will come in handy later on in our discussion, but ever since this whole DOGE refund check idea was announced, whether it's $5,000 checks or $8,000 checks, there's been debate as to whether or not this would cause inflation. And in fact, James Fishback himself, which is the guy who basically created this idea, he's a CEO at an investment firm, he said in his official write-up that it would not cause inflation, primarily for two main reasons. One, because this is not deficit-funded money, which means the money already exists. And secondly, because the group of people who would receive it, taxpayers, are more likely to save it. Now, I'm going to focus on the first point in this video because that's what I've heard repeated time and time again all over the internet. Except that people seem to be using deficit-funded and money printed interchangeably, which I guess on the surface kind of makes sense because how do you fund a deficit? You do it by printing money, except not technically. And I'll get to that in a moment, but when people say this check wouldn't cause inflation because it's not printed money, they're referring to the 2020 and 2021 stimulus checks, which did cause inflation. In fact, there are studies that attribute up to 30% of peak inflation directly to stimulus. With that said, that money also technically wasn't printed money. It was borrowed money. The government basically sells treasury bonds and then uses the funds to fund its deficit. In that instance, yes, the Federal Reserve was one of the largest buyers of government debt. And printing money is essentially when the Federal Reserve poofs funds out of thin air and puts them on a digital reserve and then uses them to buy treasury bonds. And this, of course, puts money in the pockets of anyone who owns treasury bonds, whether that be the US government or individual citizens. Here's the thing though, the Federal Reserve cannot buy treasuries directly from the US government, so instead it scoops them up on the secondary market. Regardless, the 2020 and 2021 stimulus checks weren't technically printed money, but they were deficit funded, as in the government borrowed money to then fund the stimulus. Now, people are arguing that this DOGE refund check would be different because that's not what would happen. Instead, this would be funded by money that was found or saved by DOGE cutting wasteful government spending. And thus, since new money isn't being created, you're not increasing the money supply, so in theory, you're not increasing inflation. And this is where the discussion of two different types of inflation comes into play. There is monetary inflation, which is the devaluation of currency by increasing the money supply. They are right when it comes to that. This wouldn't do that. The thing is, there's also price inflation, which is what we actually experience when we go to the grocery store and everything is more expensive. Now, price inflation can be caused by monetary inflation because if you increase the money supply, prices are going to get more expensive even if nothing changes because the value on a dollar basis has to increase to compensate for more money circulating in the market. With that said, price inflation can also be caused by many other things, like corporate greed. In fact, there are studies that also point to 30+% of peak inflation being caused by corporate greed. Now, corporate greed has nothing to do with printing money or deficit spending, and it still can cause massive inflation. Why? Well, precisely because there are two types of inflation. And price inflation can also be caused by too much demand for any given level of supply. Basic economics dictates that you'll get equilibrium when a certain level of supply matches a certain level of demand. If you cannot quickly increase that level of supply, but you have a surge in demand, you're going to have to increase prices to find the new equilibrium. And when it comes to these checks, giving $5,000 or $8,000 to every taxpayer or every tax-paying household, whatever the final proposal ends up being, will absolutely increase the demand for everyday goods. and definitely the demand for goods that are inside the CPI basket. And why is that? Well, one, because of natural consumer behavior. But secondly, more importantly, because even though this money isn't created or printed or isn't funded by the deficit, the fact of the matter is money in consumers' pockets is vastly different than that same amount of money being spent on very niche government contracts. These military and government contractors take that money and they might invest it in research and development, but they might also put it in their bank accounts. Whereas instead, taking that same money and giving it directly to American consumers will absolutely increase the demand of pretty much everything that consumers buy. And when we're talking about inflation, we're usually talking about either CPI inflation or core inflation, and consumers directly dictate that. That's why it's called the Consumer Price Index, not the Government Contract Spending Price Index. So when James Fishback says that this won't cause inflation because it's not deficit funded, my response would be an example in something that he's very well versed in, and that is investing. When it comes to investing in the stock market, every stock has a market cap, or a market capitalization. And this is basically the price per share multiplied by the shares outstanding. But there's another metric that is a lot of the times important, and that is the float. Now, the float and the shares outstanding are different because the shares outstanding are every single share in existence. The float, though, is only the group of shares that are available for trading. So here's my point. If you increase the float of a stock, that will have a noticeable impact on the stock price, even though you didn't increase the total outstanding shares. Why? Well, because basically you're taking shares that are in reserve and injecting them into the tradable market. This will usually have a negative effect on price because you're increasing the total shares available to trade. This exact scenario, except on the demand side and not the supply side, would happen with everyday goods. You would increase the dollars circulating that are available to chase the same amount of supply, thus creating an imbalance in equilibrium between supply and demand. And unless supply can surge quickly enough to counter this new demand, you will get higher prices, thus inflation. The point of this video is it doesn't really matter where the money comes from. It doesn't matter if that money was printed, or if it was deficit funded, or if that money already exists. If you divert money that was going this way, and instead you move it this way, directly into the CPI, you're going to have inflation simply by a function of supply and demand, by increasing the total demand for the products that we have available. So in my opinion, if these DOGE checks happen, yes, they would cause a noticeable increase in inflation. Now, that's not to say that it's not a good idea. In my opinion, if DOGE can find legitimate places to cut wasteful spending, that's a good thing. Although, in my opinion, it might also be more prudent to use all of those funds to pay down the massive national debt, which at the time of this recording is well over $36 trillion, and it moves so fast that I wouldn't doubt if it's already $37 trillion plus since the last time I checked. I hope you found this video informative, and at the very least, I hope that you now know that there are two different types of inflation: monetary inflation and price inflation, and they both matter and they're both related. If this video was informative, please consider subscribing. It helps out the channel tremendously. And if you like personal finance, world economics, and investing broken down simply, you are in the right place. So I hope to see you around for the next video. Until then, have a fantastic rest of your day, and I'll see you in the next one.